moves to the upside like you've never seen in your life before. You think that Bitcoin's 20 Bitcoin doubled 22 times from when I bought it initially. It doubled 100%, 100%, 100%, 22 times. You think that's impressive? Watch. David's asking, Oliver, how do you monitor the world markets in relation to each other? You have to have an overall macro view of things and kind of know through experience, knowledge, training, how these macro things fit together. You have to be also aware of macroeconomic cycles, right? So, for instance, if you know that the US's monetary policy is one of the biggest engines of global growth or the lack thereof, then you want to focus on the US's monetary policy. Okay? Specifically, the actions of the Federal Reserve. Now, the Federal Reserve will basically be in two, either on one side of the coin or another side of the coin, and that is they're in a quantitative easing mode, or they're in a QE mode, quantitative easing, or QT mode, quantitative tightening. Now, without being too specific and being too nerdy with this stuff, the bottom line is that is the Federal Reserve making money available, or is it taking money out of the system and making it less available? Money being dollars. Is it flooding the world with extra dollars? Because if that's the case, all hard assets are going to rise because the dollars become less valuable when you flood more into the system. And if the dollar becomes less valuable, whoever receives these extra dollars will immediately switch this melting ice cube to something that doesn't melt as quickly. Real estate, Bitcoin, gold, Apple. So stocks became something that melted less than the US dollar. So people would get these dollars and give it to Apple. Get these dollars, give it to Microsoft. Get these dollars, give it to gold. Get these dollars, give it to real estate. Get these dollars, give it to Bitcoin. When the opposite takes place, boom, you pull money out of the system. Now dollars become more scarce, which means that the dollar becomes harder, actually, it becomes a harder money temporarily, right? That people flock back to the dollar. And so the inflation that excess dollars created in the real estate market, in stocks, in gold, Bitcoin, whatever, that comes down a little bit because money is being sucked in the system and people sell those to go back to the dollar. This is an oversimplification of things, but this is basically what it is, what's happening. And then the cycle repeats itself. Now, what you have to also understand is that the Federal Reserve, every single time it starts goes to QT, it starts taking liquidity out of the system, it has to go back to QE, flooding the system with more dollars faster. So in the past, it could tighten and pull money out of the system and wait a long time before it reversed. But each time, it kept getting less time and less time and less time. So we're pulling money out. Oh, no, we have to pivot now. Now we got to push money back to the system. And he said, oh my God, we have to pull money back out? But all of a sudden, everything starts collapsing too hard. Oh my God, we have to put money back into the system. And so each time they try to fix things by pulling the reins back, something breaks. And then they have to start pushing money back. Oh my God, we can't have that break anymore. And each time something breaks faster and faster and faster. Let me show this to you. I can show this to you. It's quite hilarious, to be honest with you. I can show this to you. So take a look at each time. So the way you pull money out of the system, the way the Fed pulls money out of the system is to raise interest rates, right? So each time you see the raising of interest rates, right? Rise interest rates, boom, they have to lower interest rates. They have to reverse Rising interest rates pulls money out, lower interest rates pushes money back into the system, right? So you have to lower it again because something started breaking right there. And then they're like, oh my God, we got to control inflation here. It's getting too high. But let's raise interest rates. Boom. And then something breaks and they have to they have to change course and lower again. And every time they lower, it gets lower. But every time they pivot, right? The pivot is lower too. So they can't ever raise as high as the last time. See the high here and the high there? They can't ever raise as high before they have to pivot. Now look. You know what's going to happen here, right? Boom. And when that happens, oh my God, you're going to see a risk on, right? You're going to see, guys, a risk on scenario. You're going to see moves to the upside like you've never seen in your life before. You think that Bitcoin's 20 Bitcoin doubled 22 times from when I bought it initially. It doubled 100%, 100%, 100%, 22 times. You think that's impressive? Watch. I am telling you, just watch when the pivot this time happens. And it's not going to happen from when Bitcoin's 3,000 again. It's going to happen from a higher point. I don't know what that higher point is. Maybe that's 20,000. Maybe that's 22,000, 21,000. Maybe that's 15. Maybe that's 18, whatever. But as long as it's higher than the last time, 3,000, as long as the drop is higher, I am telling you, when the pivot comes, all you're going to be able to say is, oh my God, Oliver nailed this thing. I am not doing anything special. I'm just showing you history. I just showed you how every single time the Fed has to reverse course earlier than it did last time. Every single time. Now, if that changes, my theory is wrong. All right. Okay. I'll be wrong, and I might just have to knock on your door and ask if you have if you have an extra room somewhere in your attic or your basement or something like that. I'm telling you that if it doesn't happen like that, I will need counseling and I will need some place to stay. Not because I will lose my houses or anything like that, but because I just won't be able to stay there. I don't eat a lot. I read a lot. I'm very quiet. All right. I bet, and I bet big. It's just the way I've always been, guys.